Master your money, free your future. Welcome to Budget for Life. My name's Jeremy. I'm not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. In this video, we want to talk about what are the odds that GameStop is considering Caesars as its acquisition target. So in the news, Caesars has talked about how they are interested in being acquired, and as a little bit of tinfoil, GameStop also posted some potentially slices of pizza from Caesars. Obviously, Little Caesars Pizza is a different company, but could GameStop be giving a clue here? Also, we know at a high level, Caesars, it does have a sleepy management team, right? It is retail oriented slash in the entertainment space. So we want to go through, right? It's potentially a diamond in the rough. It would potentially be considered a meme play, which Cohen bristles at. It's publicly traded. Does it meet all the qualifiers? How reasonable is this as an acquisition target for GameStop? Could GameStop even afford it? Is it big enough? Right? Are there any NOLs, etc., etc.? Let's dive into it because there's something here when a company says we're interested in being acquired, Caesars Entertainment, another company says we're interested in acquiring, right? There's all the speculation you need, but when you add in that it does meet at least some of the qualifiers, we'll dive into the rest of them, and maybe a little bit of uh, potential signaling from the company as well. It's worth taking a look at. It's worth expanding our horizons. This is not a company I have even considered in the past, so I'm excited to look at does this make sense potentially for GameStop or not. So let's look at Caesars. On the surface, how large are they? It's a $5 billion market cap. Okay, so that is basically the same market cap value as Macy's. And from a revenue perspective, let's check out what they were doing. So they did 2.9 billion in revenue in 2025. So not huge from a revenue perspective. That is, I would call that, let's just call it 3 billion. Is this big enough? Right? Because Cohen said it's going to be very, very, very big, really big, really big. Right? So is a $5 billion company with 3 billion in revenue, is that large enough? They are international, or maybe they're just regional across the US. That I would call that a yellow flag. I wouldn't call it orange personally because this would be big. I mean, this would be, it's a $5 billion purchase, 50,000 employees, and a premier brand. I would say like probably the number one brand in the casino space. Are they the number one performing company in the casino space? Maybe not, but they are a super well-known brand. Is this big enough? Again, similar to Macy's, I would give it a yellow. It probably is big enough, but if there's a reason why they wouldn't do this deal, that might be one of the reasons. Are they undervalued? Okay, that is really interesting because they are unprofitable, right? They have operating expenses of 2.5 billion against their 2.9 in revenue in 2025, and their operating income, they do have some operating income. So the core business hypothetically is profitable. Oh, actually this is the year ended. That's the 3 months. Okay, so for oh, geez. Okay, they did 11.5 billion in revenue in 2025. Okay, that's good news. This is 11.5. I think this is probably big enough, but I'm going to leave the yellow on there because I also have it there for Macy's, but I also think Macy's is big enough. Okay, going back to the operation. So they have 1.8 billion in operating income. However, they have so much debt that they are unprofitable. So on a price to earnings basis, they don't qualify, right? On a forward 12, I wonder if they have like Caesars P forward PE based on their like projected 2026 earnings. So some people say it's 15, some people say it's 30. It kind of depends. Some people say it's even higher than that because the main question is, will they even have earnings? When you look at 2024 to 2025, their top line did grow. It's not an impressive growth rate, but for you to say like, "Oh, is this a dying company? Is this doomed?" It's like, well, maybe, maybe not. There's still demand. However, the expenses grew faster than their income grew or the revenue grew. So their operating income did decline substantially year over year. What are those increases coming from mainly? The casino looks like the biggest one, and as well as depreciation, which is a non-cash expense. So, it's I'm getting kind of ahead of myself, so I'm talking a little bit about quality durability here. But I would say like this is quality enough, durable enough. I don't think the trend of gambling is going away. Obviously, a lot of it's going online, but there's no reason why Caesars wouldn't be able to compete in that space as well if they really wanted to. And I'm sure they already do to a certain extent. But I don't think travel is going away. I don't think in-person casinos events is going away. So I think the quality slash durability, I would say, is there. Price to sales, though, let's go ahead and finish that thought while we're there. So their revenue 11.5 billion. Their price is 5 billion. 5 billion market cap divided by 11.5 gives you a 0.43 price to sales, which is just as undervalued as Target on a price to sales basis. Hmm, is that undervalued? I think at the very least it's fairly valued, right? I mean it's priced lower than Bath and Body Works on a price to sales. It's priced a third of what PayPal is that we looked at recently. I think I wouldn't even give this a yellow flag. Is that the deepest value ever? No. But when you think about the fact that the only reason they're unprofitable is their interest expense, well, guess who has a lot of cash and could pay off a lot of debt? GME. So I think that value is probably pretty attractive. If someone wants to turn this business into a profitable business, all they have to do is dump some cash into it. It's already a profitable business. Unless you think that this top line is going to invert and start declining, and you think that these expenses are going to stay static or continue to grow as a higher proportion. But what's Cohen great at? Cost cutting, right? Let's keep going. Is it growable? Is it scalable? I mean, how many, like, what do they do? I wonder if there's a little blurb here. on kind of like the bull slash bear case. Did they say anything about growth? Sports betting and iGaming. So that's what I was thinking as a growth opportunity that I'm not sure if they've taken advantage of that much yet. Okay, they're definitely the number one as far as largest property of casinos and most members. This is the number one casino. Okay, so, but they're mostly properties. Lots of competition, right? Is sports betting going to take away from their casinos? Domestic regions is where they are profitable, and international they are not. Hmm. And they have interest expense. This is interesting, okay? Like they have high interest expense. Well, again, is there a company with a lot of cash that could fix that problem? Yes, it's called GameStop. Hey, they have international divisions which are unprofitable. Huh. Do we know of a company that had unprofitable international divisions that was taken over by a shrewd expense management focused leadership team that closed those unprofitable international locations? Yes, it's called GameStop. And has a shift occurred in the gambling space towards online that Caesars has potentially underinvested in compared to Penn, DraftKings, FanDuel, MGM, Fanatics, right? All these predictive markets, even Robinhood, right? Has Caesars failed to keep pace with the industry shift, similar to, I don't know, a company named GameStop that Cohen saw and said, hey, you're failing to grow with the industry shift towards digital games, digital downloads, and digital purchases of video games, and your website's super outdated, right? We need to be a tech forward business. But since you missed that opportunity, it's going to take us years of cost cutting to get there, but we can get there, right? And now you see it with Power Packs, for example, and their website's much improved. So is there similarities here with a business that has a clear growth opportunity that it's clearly not fully taken advantage of? Overly ambitious international expansion that's caused it to hurt its own cash flows, and debt that's way too high that's caused it to become unprofitable. I did not expect what I'm finding here so far. I'm going to be honest, guys. But growth is essentially not in location, but in online gambling. That I don't know. I mean, compared to these other names, I'm sure they do something, right? Maybe it's in the other, right? Do they do at least a tiny bit? But so far it's casino, and casino might include, like, I need to know their business deeper to give a more definitive statement, but it seems like they're very focused on in person and not, okay, there's digital. There you go. Caesars Digital made 236. It's less than 10% of their business, but look at the growth year over year. 102% growth in their digital business. That's still a tiny in the EBITDA of the business, so the earnings, right? Let's see the revenue here. Revenue for digital grew 21%. So it is more than 10%, just over 10% of the revenue. But look at the uh, income. Income went way down, but that's got to be related to interest, taxes, and depreciation because their EBITDA is literally up double. Anyways, what are we talking about? Overall, potentially an underinvested opportunity, and maybe there's also a couple domestic locations they could open up, right? Gambling, the trend towards online gambling is encouraging more and more states to change their gambling laws. And if gambling opens up in more and more states, then Caesars would have the opportunity to grow substantially, right? Just one or two premium resorts can be huge needle movers for this business. Like, say, Texas, for example. Do they have NOLs? Yes. Check it out. So as of a few years ago, they had 2 billion in NOLs and they've been unprofitable in years since then. So net loss of 250 million in 2025 or 500 million gap. Oh yeah, for the full year. Okay, sorry. Fourth quarter versus full year. I keep getting twisted. They lost another 500 million in 2025. They lost another 300 million in 2024. So they have basically probably at least 3 billion, right? When you include their 2023 losses as well. I'm assuming they lost at least a little bit in 2023. So they're sitting on 3 billion in net operating losses. Do they have to have net operating losses to make sense with what Cohen's communicated? No, but I think it helps. It is a similarity to Berkshire Hathaway. Compare that, for example, to the DK Butterfly that's probably closer to 1.6, right? Caesars might have twice as much value in NOLs. In short percentage wise, check it out. 18%. 18% short. That is substantial. That's higher than GameStop's reported short interest right now, right? They're closer to 17. At least, it's honestly, I don't understand the difference between their black and their green. 17.86, 17.07 is the short float. So similar, but slightly higher short interest in Caesars. Do they need cash? They probably do based on their interest expense, but let's go check out their balance sheet. Where could it be? You're not going to tell me in this document? That's incredibly annoying. Caesars. I need to see your balance sheet, Caesars. Hmm. Here we are. Jeez. Take me to item 8. Here we go. Here's the balance sheet. Sorry, it's probably so tiny for you guys to see this. Here we go. Here we go. Here we go. You've got, let's see here. What are we looking for? Debt over cash. So let's look at the debt first. At least point 0.1 there. accrued interest, does that offset with pay with receivables? Yeah, pretty much. Prepayments and receivables offset payables and interest. There is this like other accrued liabilities that is getting pretty high compared to their assets. Like some of that we should probably go ahead and consider debt for this purpose. But they've got, look at this, boom, 13 billion in long-term financing plus 11.6 billion in long-term debt. Holy smokes. But the financing's probably related to the property, right? 14 billion in property. So let's go ahead and offset that 13 with the property, even though it's still a lot of debt though. But this debt's probably the more expensive debt. This 11.6 plus I'm gonna pull about zero point 0.4 of this along with this one to call that zero point 0.5 in kind of near-term debt. Divided by what do they have in cash? 0.9, 0.95 plus 0.13. Is that it? That's it. Look at this. They need cash so bad. They need cash so bad. Now, strength of the balance sheet wise, you're looking at 31.6 in assets divided by 27, let's call it 28 in liabilities. Not like incredible, like this is a risk, you know. I'll call this an orange flag, even though this isn't one of the qualifiers that Cohen mentioned. That's why I have it off on the right. I still think he's generally interested. But, guys, what do you think? Is there any reason why this wouldn't be on GameStop's mind? It's larger, it's a larger consumer company. It is big. I think it's not as big. I would still prefer Target, mostly because Target's a lot bigger. They literally do 10 times the revenue, and they're already profitable. So GameStop wouldn't have to assume unprofit, right? Assume losses, try to cover for those losses with their own gains, and then through another 3-year transformation process, close unprofitable locations, right? Begin improving their online, right? Rolling the NOLs into or against otherwise reported profits for years of tax-free growth. I think, it's undervalued, but it's hard to say that anything's deeply undervalued when it's unprofitable and the expenses are growing faster than the revenue. Like that is a genuine red flag. However, the entertainment space, the gambling space, the dopamine space is an incredibly lucrative space and growing. The more and more that that wealth disparity grows, the more this will grow, right? It's the it's the poorest and the richest that probably dedicate the highest dollars or percentage of their income, household income to gambling. It's high quality, it's durable, it's scalable with growth prospects. They do have a sleepy management team. If it works, it will look genius. If it doesn't, it will look totally foolish. That's for sure. He has an ability to make the asset much, much, much more efficient. That to me is like stronger. There's a stronger case to be made for that with Caesars than even with Target. because of how inefficient Target is. Target with a 5% net margin is actually like pretty solid for a retailer. It's not great. It could do better. But Caesars being unprofitable and its expenses rising and even having locations that we know are unprofitable locations, it's like, well, man, yeah, we could make this much, much, much more efficient, right? GameStop has the capital and Caesars needs the capital. GameStop has the operational expertise as it relates to cost cutting, closing unprofitable locations, and investing in key areas of growth. Way more compelling than Bitcoin, right? Similar to Berkshire Hathaway, this would be similar in terms of Caesars being meaningfully differentiated from GameStop, right? It wouldn't be the same type of business, which Berkshire Hathaway manages a portfolio of companies that are meaningfully different. So it would check that box. It would also check the box of NOLs as far as similarities to Berkshire Hathaway. Is it fast enough? Is one of the questions, right? They're attempting to do it in a much shorter amount of time, but they're comparing it to decades. So if they can buy Caesars and within 3 years, like 3 years later, Caesars is a cash cow, that that would be a much shorter amount of time, genuinely. It would still feel long to be like, oh, we just reset the time clock for another 3 or 5 year transformation. But it would, 5 years is still pretty fast in terms of projectable outcomes. Increase the profitability very, very quickly. Again, the quickness of the turnaround, I think Cohen could say, hey, if we do this turnaround in 3 years, that's still a lot quicker than Berkshire Hathaway. What really needs to be quick is the increase of the profitability of the company, which Caesars, they would be able to do that much quicker than a Target because the cash does it overnight. Like, boom, you've got 10 bill in debt. Boom, we've got 10 bill in assets. Boom. Now let's get a new convertible at 0% for 10 bill instead of 4 bill. And now we have 20 bill in assets and 10 bill in interest free debt with 8 year terms, right? Like you very quickly, just through GameStop's capital, become a scary company with billions and billions in NOLs. And what's crazy, guys, and I don't even like this, okay? Because there's so many bots that are AMC, yada yada. I have said I don't think GameStop's interested in buying AMC. I've said the only way I could see them buying AMC is if they're interested in basically closing AMC theaters, but rolling AMC's NOLs into Dave and Buster's. Dave and Buster's was the only other retailer I could think of that might be able to use AMC's NOLs. I didn't think of Caesars. Caesars has theaters. They do shows, right? They could potentially use another 5.3 billion in NOLs that they might be able to scoop up for 100 million bucks, right? This thing is just declining more and more by the day because it's a doomed company, right? But there could be a golden parachute from Cohen if he wants these NOLs badly enough. However, the leadership of this company might be so corrupt that they refuse to sell, and that's fine. It's not like Cohen needs those. I'm just saying, if he has any interest in these NOLs, I don't think it's to be used within AMC's theater business. I think it would be used in a different type of entertainment that has enough carryover, enough similar lines of products that the same NOLs could be used in a much more quality, much more durable, much more growable and scalable business. Oh man, I hate this, guys, because I do not want GameStop to buy Caesars because I do not personally, from a values perspective, want to own adult entertainment. I am fine with owning power packs, fine with owning a casino, even, but I would not be pumped to own a company that features as a tiny sliver of its revenue, probably, but features adult live shows and performances. Like that for me would be dreadful and probably would be like a okay, what's the quickest most reasonable exit that I could make because I don't want to own that business. That said, Caesars makes a lot of sense. It makes a lot of sense. And I wouldn't put Cohen past owning that type of business. Cohen has said before he has a crude humor, right? Like he's obviously he's made like provocative uh, memes and whatever on his X account. I don't think he's afraid, from a. I don't think he has internal qualms about, man, would I really want to own Caesars? Am I okay with that morally? I don't think he's worried about it, to be honest. Now, if it's not Caesar, here's a couple reasons why I think it wouldn't be Caesars. So the biggest one is it's still not quite as much scale as what we could be looking at with the target. There's not necessarily um, as so. Anyway, sorry. The scale of the revenue, the size of the company, the value of the company, right? To be paying the same in price to sales, but one of them makes 5 billion a year and one of them loses 500 million a year. That's like this is a deeper value play. I think both of them are very sticky customers in terms of how do you delight the customer? How do you provide experiences that keep them coming back? So that to me is kind of a moot point. The potential employee leak, right, of GameStop moving some of its stores into a business it could acquire, that becomes probably not an accurate leak, which is fine. I don't think that has to be an accurate leak by any means. And as someone mentioned in a comment to me recently, like it could still be an accurate leak. And actually, they are just going to partner with a Kohl's or a Best Buy. Like they're just going to lease some square footage space within a company that they don't buy, right? They're not buying the company. They're just leasing some storefront because it's going to be cheaper to put their store inside of a Best Buy than to put it in their own space, right? It's just operational synergy. It's not actually part of an acquisition target. So the leak could still be accurate, but I think if the leak is accurate, I think it makes more sense if it's through an acquisition. And GameStop is not going to put their stores inside of Caesars casinos. And even if they did, right, it would not, there's only a couple of these. It wouldn't be like, Target 2,000 stores all across the US. You know what I mean? Um, what else? What else? What else? I don't know, guys. I guess the other thing is just how much of their operational expertise carries over, right? A casino would be pretty different from Chewy, pretty different from GameStop, whereas a more traditional brick and mortar retailer would be much more similar. Is there enough operational expertise here? Is there enough carryover? I think there probably is, but maybe not. Right? So I'll put like a, but other than that, like I think it's a super meaningful chance. What do you guys think? Let me know in the comments if you feel differently, if there's anything I'm missing as far as what would make this more or less likely. Obviously, the reports are that the people interested in buying Caesars are MGM, Tillman Fertitta, who owns Landry's. Like the people that do this business are the names that people are thinking maybe they would be interested in owning this business. But it doesn't mean that GameStop is not interested in owning the business themselves. And they do become profitable overnight, but you're also paying for it, right? It's a $5 billion company, but not as much dilution for shareholders that way. And the NOLs, again, it's kind of like once you turn profitable, you still get that profit tax free for years until you use up all those NOLs. And potentially could be coupled with some even more NOLs down here. I don't know, guys. Much more, much. It checks many, it really checks all of the boxes, to be honest. I just like, oh, the other thing I was gonna say, uh, this post, to me, you could take it either way. And it's similar to the Target situation, right? The head of social media at GameStop posted this meme that said, "What's the target?" And then he just laughs. If that happens, does that make it more likely or less likely that Target is the target? Because if Target is the target, would they really, would the head of their social media really post that to maybe clue people into it, right? Or is it, hey, there's plenty of plausible deniability. He's not talking about like there's no reason why he wouldn't because he's not giving anything away specifically. The thing is though, the same thing applies with Caesars, right? If Caesars really is the target, would GameStop really be giving a hint? Would they really be giving a hint on their main social media profile that perhaps they're the ones interested in Caesars? If they're really interested in Caesars, wouldn't they want to keep it hush hush until the deal's done so they can secure as good of terms as possible? That said, in either case, the what's the target meme or the Caesars pizza meme, in either case, you could say that, well, the terms are probably already by and large agreed to. And so if either stock moves on either of these X posts, it doesn't really matter because the terms are already agreed to. So perhaps these are clues. Perhaps they're anti clues. The only problem is we have one for each. So when you're putting the odds, like what makes one more likely than the other, it's hard to say that um, oh, Caesars is less likely because of this pizza thing. It's like, well, then what about the what's the target thing? I do think what's the target thing is a little bit more ambiguous, and it was just from a person that works at GameStop. It was not from GameStop's account. GameStop's account operates in a way to generate clicks. This guy's personal account does not. So I do think there's something to be said like this. I do think there's a little bit of a less chance at Caesars in light of this, and more a hey, let's just get people talking compared to the what's the target meme. That said, like the biggest reason for me is Cohen's operational expertise. Does he really know the casino business? Does he know the casino business? Is the casino business similar enough to retail? That to me is the biggest reason why it wouldn't be is the operational expertise. I think the size is big enough, and I think a lot of the other things make sense. Oh, I gotta, and this to me just feels like surely it's not Caesar's. It just feels like that to me. But I gotta say, a lot of it makes a lot of sense. I mean, I kind of want to say like move if we move Kohl's down to 5% and Macy's down to 15% and Target down to 60%, then we carve a 20% for Caesars. Is that fair? I think it maybe should even be a little bit higher, guys. Uh, the only thing is it's a casino, right? Is the operational expertise really there? And mm, I think maybe if we make this hmm, if we make this 50-30 target Caesars, then there's still in my mind it's still a 70% chance that it's a retailer and a 30% chance that it's Caesars. The reason I'm giving Caesars such a high odds is because the capital is uniquely helpful for Caesars compared to these other businesses. The clear areas of unprofitability are very easy to identify for Caesars compared to maybe some of these other areas. The clear opportunity for growth is there for Caesars compared to some of these other areas. And the NOLs and short percentage, I think, is probably uh, aligns better with Caesars than any of these others, even if you factor in a DK butterfly. Hmm. Let me go 25, 75. 75% that it's still a brick and mortar retailer, 25% that it's Caesars. As an investor, I think this opportunity is an exciting one. It's not a name that I'm personally going to be going into because, again, I do not want to own adult entertainment. I don't think it's good for society. But as a deep value play, like I have a hard time imagining that someone wouldn't be interested in paying more than 5 billion for this company. All it needs is better financing and it's done. Better financing, close a couple unprofitable locations and it's done. Then invest some growth into some online gambling and it's done. You know what I mean? Like I hope it's not from my soul's perspective, but I kind of hope it is from an opportunity perspective. Like it seems pretty compelling. What do you guys think? Could it be Caesars? What am I seeing that you agree with? What am I missing that you want to point out? What am I seeing that you disagree with? Let me know in the comments. That's all I got for you today. I'll see you in the next one.